And I'm proud to be among you. You are the ones who drive the economy, who drive innovation, who create the productivity, which improves the standard of living for everybody. So, first of all, feel good about it no matter what the economy is telling you right now. You're brave, you're bold. Memphis has an entrepreneurial history that's really deep and it's really rich, and we hear a lot about it, but that's yesterday. So let's talk about now, right? Well, what do we need now? Well, I believe that in Memphis, the entrepreneurialism still permeates all of us, but what we need to be effective today as entrepreneurs is we need good business plans, we need good people, we need good strategies, and unless you are independently wealthy, you're going to need somebody else's money to fertilize your bag, right? And without that, these business plans and visions amount to nothing more than dreams. Okay, so the idea today is really to pull together a panel that is deep in understanding early stage financing. The idea is to figure out what compels them to make an investment. What can we do as entrepreneurs to convince them that the combination of our capabilities and their capital will lead to the birthing of the next giant? So I'm going to leave my comments brief. The way we're going to run the agenda, unless somebody in here says no, let's not do it that way, is I'm going to have each of us kind of go through, introduce ourselves, talk about the organization where they currently reside, talk about their experience with early stage financing, and then I have scripted 4 questions to which I have presented them, and I will ask them and give them a chance to respond. We'll try and keep this moving pretty quickly though, because we want to have plenty of time to do audience Q&A. Does that work for everybody? Yes. Okay, so I'll start. David Waddell, my firm Waddell & Associates, is a wealth management business. We manage about $550 million for individuals kind of all over the U.S., but mostly in the Southeast. We have offices here and also in Nashville. So that's my day job. As far as my early stage funding experience, I am currently very alive in that. My lawyer right here, Jeff Goff, thank you for all your work, and some others. We started an institutional asset management firm. We are in the process of raising $1.5 million in seed funding. We acquired about half of that, and to tell you how relevant this is right now, I made a call this morning at 10:30 and requested another participant. And of course, as an entrepreneur, I'm optimistic that they'll say yes. So that's my background and experience right now. Gordin, you want to?
Gordin McMurtry, Paragon National Bank. I've been in commercial banking in Memphis for 18 years. At Union Planners, Regions Bank, and now Paragon National Bank. At Union Planners and Regions, I ran the commercial lending group, the small business banking group. At Paragon, I run the commercial lending group.
My name is David Waddell with Addison Capital Advisors. I formed that about 6 years ago to work with early stage and startup companies. Basically providing a lot of the back office support and then and also the accounting, and that evolved into helping procure capital, and then the next thing I knew I was part investment banker, part outsourced accounting, and a whole lot of other things. Along with a partner who joined me a few years ago, we formed a small capital fund as well, TCD early stage.
Tim William over Memphis. Been doing this about 2.5 years. We started October 2007. Really investing in early stage companies from Memphis and across Tennessee, primarily biotech, medical device, and also technology companies. We've done 8 investments throughout Memphis, and then 1 outside of Memphis in Knoxville. We have an office here somewhere.
Good afternoon. My name is Andrew Seamons. I'm with Pittco Capital Partners and Pittco Management, which is the family office for the High family here in Memphis. We manage a wide range of assets, but we have several funds for making direct investments in companies. We also invest in venture capital funds and private equity funds around the world, so we have a view from both sides. I came to Memphis about 10 years ago to join a group called Paragon Capital, which was somewhere between an angel network and institutional venture fund. And prior to that, I was on the other side, like many of you, with lendingtree.com. When banks compete, you win.
As you can see, this is a terrific panel, and so we've got a lot of good information up here, and hopefully we can translate the mystique of the funding to the entrepreneur. So here's question 1, and I've been prepared with this, and we'll just roll through it. Describe the most compelling early stage pitch you've ever heard. What made it so compelling? Did you fund it, and did you make money? As the spirit moves.
I'll start with one. I had 3 guys that came to me that were all from industry, that were starting a company in that industry. So they were experienced managers. They had intellectual property already in the field. They were starting a company. And they had a lot of funding already committed. So they're looking for a lead to take it to market. We like the idea, felt we could get it started fairly inexpensively. We liked the projections. They had 2 more products in the pipeline after the first one launched. We thought that was pretty big too. And so we put a certain amount of money in. As soon as we could, we put more money in, and then just put a third amount of money in recently. Don't think that's going to make money. The product is the market, so it's actually getting some revenue, so we're pleased with that. But it was something that kind of hit all the things we're looking for. A unique niche, a competitive space that had a large market size, experienced folks in the space, not entrepreneurs, but experienced in their space, and a reasonable amount they were trying to raise. So for us, we thought that was pretty good.
I'll give a recent example. I'd like to say we've already made money, and it's a big success story, but it was compelling enough that it was a good story about entrepreneurs. I'm going to be a little suspect about it because I'm not sure they're out of some stuff. But this group started developing a technology because they wanted to be able to, it was something that needed to be synchronous no matter whether you were working with somebody in Russia or the United States. And I mean synchronous down to the microsecond, things going on over the internet. And so they started out with this idea, and it was more of a consumer application, and quickly realized, you know, great application, the technology works really well, but this isn't going to make us any money. So with their existing venture capitalists, they sort of looked at what they developed, retooled their business plan, and the demo that I just saw fairly recently was it allowed sort of any device, a netbook, your iPhone, a computer, anything virtually, to have the experience connecting into a computer somewhere else as if you were right there. I know that's, we've all seen applications like this, but on your iPhone, you could be running the highest caliber game or the biggest AutoCAD software that would require a giant system, a giant computer, and to be doing it from your iPhone or a really dumb netbook. So it really brings us closer to the point where we are all running around with really cheap, end-use components, and our software is also residing somewhere in the web, and things get a lot cheaper and more ubiquitous. And it was compelling for a number of reasons. Obviously, clearly, a great development team, very defensible technology. We could see it was working because they had demos. I mean, I saw it with my own eyes. But more importantly, this is a group that was able to, have a miss, a great idea, it didn't work, was able to adapt, try something else, and really find success. And so many times these business plans don't work exactly where you think they're going to, and that adaptability is really impressive. So we'll see what happens with that one. We're not even sure we'll get the fund, but hopefully they'll be successful.
So probably one of the most was about 10 years ago, and it was before I formed Addison Capital, and I was working with family investments. And there was a deal where an institutional firm was putting money in, and it was an opportunity for individuals to also invest along the same terms. It was, I don't know that I want to throw the, well, anyway, everything was fantastic, very compelling. You got an institution, you're going to, as individuals, you're going to be in on the same terms. You get the deal, 8 months later, it's gone.
Several years ago, I was approached by a company that I had done business with at a previous bank. It was a government dealer that also had a wholly owned subsidiary. And the general manager of the dealership wanted to purchase the wholly owned subsidiary. He didn't have the capital, the money he needed to do it. And purchase price was $80. A lot of blue sky. He wasn't really buying any assets. And lack of collateral was not really a bankable type loan. But we were able to approach the SBA, and we did an SBA loan for $750,000. Had seller financing of $350,000, and the individual put up $120,000. And then the bank did a $750,000 working capital line of credit to finance accounts receivable inventory. It's been a very successful company.
Just to clarify, SBA, a Small Business Administration, it's a loan that has government backing up to
Yes, in this case, 75%. But today you can get backing up, a bank can get a guarantee up to 90%.
Right. So the bank is a place to approach for early stage capital, and if SBA is a fit, then the bank can.
That certainly can. A lot of people start their companies using home equity lines today. So they have equity in their home. That's certainly been a use funds to do that.
Excellent. Describe the most common mistakes that entrepreneurs make when they pitch you on their early stage ideas.
All right, since I started before, I'll start again. The ones that we make the most fun of, and we do love it, wait till you have you love to hear folks come in and say, okay, there's nothing like it in the market. We have no competition. We're a first mover advantage. The entire world is our customer, and it's only got a $10 million pre-money valuation. That's pretty much the kiss of death right there. Because we don't believe that. So the first thing I tell us is, look, what really is the addressable market? And it's not everybody in the world, I don't care what it is. So give us a realistic addressable market we can understand. Tell us really who the competition is. Because if you don't think there's any competition, you're wrong. There's always some competition, and you're just not thinking about it deep enough. If you really think the company's worth $10 million a day without anybody putting a dime in it, you're going to have a tough time making that sell because folks just don't. They don't want to put the money and get diluted right off the bat. And then the last is you've got to have some kind of realistic marketing plan. The other one that we skip is that we have folks that come in and say, this we think is a great idea. We've never done it before. I've always done something completely outside the space, but I think it's really cool. So we can match you up a lot of times and give us the table with other experienced entrepreneurs, other experienced people in the industry. But you've got to have some willingness to do that. And the last thing for us is someone comes in and just says, this is my plan. I'm not open to any input from you. I'm going forward no matter what. For us, that kind of is the real bad. One of the things I use that David kind of asked for criteria and stuff, I use something called the Atlanta Hartsfield test. And for those that haven't heard of that, it basically says, if I got stuck for 12 hours in Atlanta Hartsfield Airport, which I have before, with someone else, after 12 hours, would we still be speaking together? So if you and I are sitting there and you're asking me for $1 million or $2 million and I can't get along with you, we're going to have problems. So if you look at kind of failures and things that have gone on, if I don't believe we can work together, that's usually where the biggest problems come out. That's kind of the opposite end of the worst. We're seeing all of those.
I'll echo that. It's some of the things he's saying. And when you come in and pitch to us, where you really go wrong, you've got to know more about everything about your plan than anybody else on the planet, and really spend the time getting to know that, talking to everybody in the industry, anybody that could be a competitor. And I can't tell you how many times people come in and sort of naively blow over an entire sort of section of a business plan, when it's really fairly simple stuff to go out there and research. And so you have to be the expert. The second would be spending too much time concerned about terms and valuation. That will come later, and you can say you want a $10 million valuation or what have you, but the only way you get the valuations you want is to have a really credible plan that more than one person wants to back, to create a little competition. So that sort of fixes itself. You really got to get the business plan and be passionate about it and get it and be the biggest expert on the planet. An example the other day, a company was in and it was a brand new manufacturing process. Great product, they had lots of good test data. It's probably going to work. But when they got to, well, this is a new process, so what about possible problems with manufacturing. It's not going to be any, we know, this will be fine. You know, it never works out that way. It's never that easy. So at least acknowledge that there might be some issues and think about it. So, you know, you've got to be straightforward and open and really thoughtful about it.
Let me augment one thing in a second. We brought to my example from last week. We looked at a company for the last 2 years. So that's the other point a lot of times. If you don't get it the first time, you may want to come back again and again if there's something that somebody likes and says, give us an update. So this company's been back 4 times. We liked them enough to say, you need to tweak your plan. So we're getting along pretty good. We're saying, okay, we're close to doing this. And the CEO came back in and said, look, I just screwed up. I realized that I had made a massive mistake in the pro forma. And I was really wrong on one major assumption I want you to know about. And I said, well, you understand, any changes are to tell your evaluation process. He said, yeah, I'd rather I bring it to you than you find out later. Now, we're still concerned with the deal, but he went up about 10 notches in my book because he wasn't trying to buffalo with stuff. And so that's another big one. Andrew kind of wrote it. If you're aware of a problem, don't try to slide it through and hope that our ignorance doesn't catch it. You know, we got to work together once we give you the money. So tell us right up front. Because if I catch it and come back, then all your credibility is gone. Credibility's about the only thing you got. So be really diligent. It helps us a lot if you do your due diligence on the front end, so we don't have to do as much. We're still going to check. I mean, we're going to go check the stuff this guy told us. The point about manufacturing is key too. I mean, tell us as much as you can so we can verify that as opposed to having to find out.
I mentioned in my preamble, the introduction, that I end up sort of as an investment banker a lot of times on the things that we work with. We've made investments, these are deals that are very early, and then they're growing and they need additional capital. So I've sat on the other side of the desk with these 2 guys a bunch of times. So I wanted to hear their answers first. I was making some notes. Well, I would echo all the things that they said. I hope, I don't think I've made too many of those errors such as these guys. But one thing that I'd say, even a step back from that, is there are a lot of times where somebody comes in and they sell their product, whatever their product or service is, and they do this product demonstration and they get at the end of that, and that's a very interesting product. If you're talking to these guys or whoever, you're not selling your product, you're selling your company. And so if you just sit there and talk about your product, the first question is, well, then how do you make money? What do you think? Well, everybody's going to want, everybody's got to have one of these. And so that's probably the biggest thing. And I attended some things out in Los Angeles recently in the fall, and then another little pitch session, and there was a follow-up to that, where there were several companies, 12 companies that were pitching in 10-minute little quick pitches. And I'd say out of the 12, probably 8 of them did product pitches. And the panel that was sort of being pitched to, which were credible VCs, big West Coast, very credible VCs, and then also like 2 or 3 of those, and then one angel network. At the end of it, they're like, I still don't know what you do. You got something cool, but I don't know what you do. So that's probably the biggest pitfall.
Banks don't finance startup companies in the way that investment bankers do. We don't take ownership, and we don't take warrants in their company. And our rates of return are based on the interest that you pay on our loans. So our risk aversion is totally different. So when a startup company approaches us, we look for capital, which is one of the things that you may be getting from these gentlemen. Got to have active capital to fund your plan. The bank can't provide capital. We can provide working capital. Cash flow, we've got to understand how we're going to be repaid. Poor business plans, not well thought out, as you gentlemen said, not good strategies. So those are some things, capital and business plans.
Quick answer, let's just start, Andrew, and move this direction. What percentage of the asks get?
Couple percent, 1 or 2% maybe?
Yeah, I'd say less than 1%.
Around that.
Yeah, I would agree.
It's easier to get into Stanford, that's what you're saying. All right, So I'm gonna ask one last question, then we're gonna open it up. Is this helpful? Are we getting somewhere? All right. So congratulations. This morning in the shower, you personally identified a business opportunity that will require you to raise $1.5 million in capital. It's a small team. It's a great idea. What do you do next? I'll start with you.
Okay, I'll start. So it echoes a little bit about what I said first, but the first thing, it's a small team, you got to identify that team. So you want to start talking to everybody that, whatever it is I just thought up, and try to find the best people out there in the world that might possibly want to join me in this venture. And then it's starting to talk to everybody I can come up with around whatever this idea is, the industry they're in, the people that would be buying, the people that would be selling to me. I mean, just to really, like I said, become the world's greatest expert on whatever it is this idea I just came up with.
Yeah, when you're looking for money, and so he sent these out last night, so I was in the shower this morning trying to think of business. I didn't come up with one. But the first thing to do is you have to bootstrap it. I mean, it's always better for us if you walk in the door saying, I've got some fun. You go to the 3 F's, the friends, the families, the fools. And probably in that order. They may not all be around in those same capacities when you finish your funding, but that's the way it works. Is you sit and put your pitch before them, and you try to say, look, this is a compelling story, I'm putting some money in, this is where we think it's going to go, and you really figure out how much money you need. I'd say one of the biggest problems we have is that folks come in with an unrealistic ask, either too high or too low. The bad problem is they walk in and say, I need $3 million. They come back 2 months later and say, I couldn't get it, so I'm going to start with $1 million. Well, which was it? Do you really need 3? Or are you going to undercapitalize and start with 1 and 6 months later come back and ask for it again? So understand the business, figure out how much you need, as much as you can do for the initial concept or prototype you should do. Whether it's an idea, whether it's a product, whether it's a service. If you can walk in the door and say, we've done a concept, we've done a prototype, and it works, and I can show you, Andrew's point before, I feel a lot better. So my idea, I've got this thing, I'm ready to go. I'm going to go to the wisest people I can find in that space and outside that space and say, what do you think? No holds barred, be real straight, give it to me, I can take it. I'm going to tweak that plan. I'm going to have a business plan. I'm going to have a very, very short executive summary. And then before I go see the big money guys, I'm going to have someone else introduce me. In the last 3 months since we won the 10 Vesco Award, I've seen 250 deals. I've got to tell you, for most of those 250 deals, I never saw them. They went to our research analyst. She did a quick scan. They didn't have some of the main things you're looking for. They were gone. So get someone to introduce you to one of the 4 of us, get a warm introduction saying, these guys are good, I like them, you should take a look. And that's the way I would handle it.
I would do all those things. I'd also base the company in Tennessee, go see Ken. Make sure 60% of the employees are here.
I'd be happy to introduce you.
I would love you, Brandon. And I may get to this later, but figure out what really makes it unique. I mean, Ken just said it. There's 250 outlets, and this is something that I've actually struggled with sitting on the other side of the table when I'm talking to these guys. I've got something and man, the numbers look great. I'm showing them to Andrew and I'm doing all this. Well, you know what? The numbers, of course, are going to look great. You made them up. If they did look great, you wouldn't be sitting there, right? Nobody ever comes in with a plan and says, Andrew, here we go. After 2 years, we're going to run out of money. But it's going to be just enough hope that you or somebody else is going to want to put a little bit more in. Then we're going to put that in. We can make it another year and a half or so. And at the end of that, we're going to exit to our competitor for 30% of what you originally put in. If we're lucky. So nobody ever comes in with that. You know, it's always, oh yeah, have you seen that one? So much. Have you ever seen that one?
We call that the hockey puck plan as opposed to the hockey stick plan. Right.
So nobody's numbers ever look like that. And it's kind of, think about it. You look at college basketball players, you're like, man, there are a lot of college basketball players in the NCAA right now. Well, when you talk about picking the ones that are actually going to be pros, there's only a very small percentage of them that make it. They're all great basketball players, and so you got to figure out what takes it from being a college level to being a pro. What makes you unique? And I would, you guys may chime in on this. There might be, if they fund one deal, there might have been 5 deals that are almost equal. You know, it's a 9.9, a 9.9, a 9.91, and a 9.9, and a 9.9. Well, they're gonna take the 9.91. And you think, well, man, I had a great plan. You know, this is an awesome idea. They see tons of awesome ideas. And so, what is the thing? And with two of the companies that we work with, I've been going out and meeting with West Coast VCs, East Coast VCs. One of our companies just presented at the Southeast Venture Capital Conference in Tysons Corner, Virginia, and it's hard. It is really hard, and they want to know what is the thing that makes you so much different than everybody else. And then also, and even if that is all in place, then is the space that you're in really that compelling of a space? Ken talked about addressable market and coming up with your total addressable market. If you're going, especially East Coast, West Coast, they want to know that it can get really big, and if it can't, then they're probably not interested. I know what the question was.
I'm not answering. It
was a shower.
I don't know. Something about the shower.
The 9.91 and how hard it is. One thing to keep in mind is the 9.91 for him may be very different than for me, so keep trying. I mean, find the VCs that have had good experiences in something related to what you do, and you're ahead of the game. I might have just had a bad experience with something similar, and you might have the greatest one in the world, but I'm not trying again. You have to keep trying.
Yeah, that's true. It's finding the right fit, and not only will it help you get funded, even if Andrew hadn't had a bad experience, and I'm trying to convince him that something we have is a great idea, and he may think it's a great idea, but he doesn't necessarily have a lot of expertise in that area. He may go, yeah, okay. If you find somebody that has expertise, they may value it better than Andrew does, so you might get a better valuation. And that's what, I think it goes back to what Ken said or Andrew said, you want some competition.
Trust me guys,
We're gonna get as many people as you want.
we're really not that smart. We may look like it with the name badge and everything else, but we're really not that bright. So when you pitch something to us, you need to be very clear and very simple. If we finish up in the first 15 minutes and say, I don't get it, then we have a real trouble. My secret, this is okay, we look at one secret. I go home at night and I have dinner with my family. So I've got 2 boys who are teenagers. If I can't pitch your deal, and I do this almost every night, to my wife and kids and have them understand what I just said and say, oh, that's cool, I get it. Now, some of the stuff we leave off, when we start getting into urinary incontinence at the dinner table, my wife makes me shut up. If I can't pitch it to them and have them understand and say, that's pretty cool, then I know we're in trouble. Now, the downside is we're getting pretty good. And I'll be there, Dad, what's the addressable market? What's the IRR? He doesn't okay, I've gone too far. It has to be clear, it has to be simple. That's two things.
Again, banks' approaches are a little different than investment bankers. Startup companies fail, and banks have to be comfortable how they're going to be repaid in that eventuality. I have a tremendous amount of respect for entrepreneurs because I know many that have failed once and they have had to pay big prices. They get back up and they start again. For example, we had some individuals approach us. They wanted to do a franchise, $300,000. These people, if the company failed, they would be able to repay the debt through other sources. And that's what the business failed, and they are now writing a big check every month to repay that debt. Tough way to do it. That's how banks look at things. We've got to be repaid. And so when we look at a startup, we've got to have the ability to repay and get paid.
I'll add one thing about the middle of it, and then we'll open it up to general questions. But, planning is the key to everything. Everything starts with the end in mind. And so in this enterprise that I'm chairing, that we're sort of raising the money for, the question was, who do we want to raise the money from? The money wasn't enough. It was, what is that person going to bring to the equation? How many of them do we want to have? What are we trying to accomplish? And so we came out, all got on an airplane, we can go through Hartsfield, but we sat and played Blackberry Farm for a weekend and just listed people. Who is it that we can build around this as coaches? Who is it that we wanted to approach as funders? Who is it ultimately that will help us achieve the goal? Who's in the family around the business? And so often entrepreneurs tend to carry it all on their shoulders and they're trying to figure out how to do it with credit cards and all that kind of stuff. The question is, who can help? I mean, a lot of these people on this panel were coaches to me as we kind of went through the process. So I think the who in the equation is very important. The money is the money. But if you can get the money and you can get one of these coaches or people that can help connect you, then you're much further along in your goal. And I think they end up really, once you fund something, you become business partners, right? And so ultimately, you're vested not only in seeing a return on that capital, but assisting that capital in the pursuit of that return. And I think that's a big component of it as well. So if you're fortunate enough to get one of these guys in the boat, if you're one of the 1%, then you get a business partner.
Can I add to that one second? Because that's really important. If you're looking for first money in sort of thing, the people you find to invest in, you really want folks that understand the business, understand what they're investing in and where it's going. You want smart money versus dumb money. I can't tell you how many deals we see 3 or 4 years into it, and the capitalization table is horrible. It's really, really ugly. We have to say, we're going to pass because this is too complex, it's too confusing. So I'll turn to my lawyer friends here, I'm sure they'll echo the same thing. You really need to do this right from the start. If you get someone that's giving you $25K, so at cocktail parties, they say, hey, let me take this deal, I mean, it's really cool. And every day they call and say, how's my money doing? You're probably in trouble. And if you've got a bad structure, and you've got a bad deal, and then you come to us and ask for something, we're probably not going to do it. I have to tell you deals I've seen with folks, and I'll pick on Mississippi just because I've seen it recently, come and say, I got about $500,000 from guys in Mississippi. What's the structure? Mostly kind of a handshake sort of thing. And I'm freaking out because I still don't know where this is going to go. And it's a personal loan to me. And my Uncle Bob gave me some money. And you need to really think of that first money and how you structure this thing, because it will affect every dollar you get from then on. There's a lot of hard stories for guys that haven't done that way. So you want the folks who are interested in helping you grow, not just give you money. That's a great point.
And get help. So Jeff, you were very helpful in us in terms of deal structure, et cetera. You can't possibly, as the entrepreneur, understand the whole spectrum of the equation, and so get help. All right, so with that, let's open it up to questions. Yeah.
I have a question.
Happy birthday.
Question for the panel. 2 questions, actually. How important is the patent? I know that's sort of a case-by-case situation. And then typically, what percentage of equity do you take?
I'll do the patent one first, because we've got a lot of experience with it. Clearly, anything that makes it defensible is better. So if you can, if you can prove that you're going to be able to lock out competitors for a while, that's great. But you can't put that much stock. It's good to have a lot of other things too. Patents are, you can get them, but then it costs $3 million to actually prosecute if somebody does infringe. So most startups don't have that. But it's better than nothing.
It's sort of nice to have.
It's a nice to have. It's certainly nice to have.
We'll do patent search as soon as you call us and say, hey, I've got some sort of IP, intellectual property. We'll go back and say, let's do Google Patents. So you ought to know what we're looking for. We'll look at Google Patents, we'll do as much search as we can around it. We'll look and see what else is in the space. We'll try to look and see, is it something we can understand? Has it issued yet? Is it a process patent? Is it a method patent? Is it a product patent? How much longer does it have? Can you expand out? And then we try to see if we can rip it to pieces. So if we were the other guys, what would they do? How would rip the pieces work? Could this thing grow? How much money is it going to take to expand it and get out there? And having said all that, I agree 100% with what Anthony said. It's still just one piece of the puzzle. If it's a really, really busy space, and there's probably 20, 30, 40 patents in this area, I'm getting a little nervous. Not saying I won't do it. I just need to understand, can I rely on that? Am I going to get sued as soon as I walk in the door? Who else is in the space? On the flip side, we may see that the patents out there are 20 years old, and they're not defensible, and maybe this is a great time to kind of walk and make something happen, and we'll go that way. So we always look at the IP, but there are actually times that we'd rather you not have patents. I'd rather you kind of have a trade secret that folks don't know about, that you don't have to disclose, that you can hold on to, and then if somebody comes and acquires you, they pick up the trade secret. But make sure that you've done the trade secret right, and everybody in the office knows what it means and doesn't go out and talk about it. That's what we do. I don't know what the second question was. Justin? Equity. We're across the board. We've done as low as $20,000 in a company to kind of get them up and running, to help them get the corporation stuff started. And we'll do a lot of stuff, early stage convertible notes, because it's really hard in early stage to value a company. I don't know if it's worth $1 million or $10 million. We've done as much as $1.5 million. We've taken anywhere from 3% equity, a lot of times we'll invest early, so we're the first follow-up guys. If I've got a foot in the door and they like us and they trust us and it goes through prototype stage, then I'm the first people that come to take a large stake. We've gone as high as 50%, but it's not a mandate for us. We try to, all the other guys that kind of vulture capitalists, we're the vulture capitalists of the high hat. I can't really be clear. That's a joke. We're not trying to take a certain percent. We're trying to go deal by deal and see what makes the most sense. What we always think through is, I don't want to put money into a deal that's so expensive that when the follow-on round is raised, I can't get money in and therefore I'm diluted, and the deal does great and I lose money. That's probably our worst nightmare. Because if you pull like a wheelchair when you sit at the family table, explain to your kids, your deal worked, I didn't make it.
I think they pretty well covered the patents. On the equity percentage, Ken said it's sort of all over the board. It's going to depend on where a company is, and it depends on what the need is. Is there expected additional need? How big is the opportunity? There might be something that's, at least perceived to be a lower risk. Probably not getting in this category, but perceived to be lower risk, and you might take a lower percentage. It can also change if somebody's trying to do a deal. If you're trying to get something funded, and you think the value of what you have is far greater than what somebody else, sitting over on this side of things. One thing is having priority in terms of payout. So you may guarantee, okay, you get the first X amount back out, your money back out plus 3 times, and then we start sharing on a certain pro rata basis. That's if you think it's going to get really, really big, and somebody's like, I don't know if it will or not. You give them assurances about their return through some mechanisms like that. So it can be all over the.
Andrew was right the 2 questions ago. Don't come in talking about terms and everything else. Let's talk about the technology. Let's talk with the team. Let's talk about the market, where it's going to go. If we like it, we'll give you advice and counsel and sit there and try to find this thing right. Usually some of the biggest problems we have is going through the valuation side, because you think it's worth a lot more than we do. Particularly that first round's really tough. If you overprice the first round, you probably won't get a second round. And you've got to really be clear on what you're asking for and how this thing's going to play. It's a tough discussion, and there's never an easy one on valuation. I don't have anybody walk in and have a valuation and go, gosh, that's too low. First time I've seen it. But you figure out the deal first, what makes sense, and then we'll work out the valuation.
Just on a structural note, right, because the math can be the confusing part. It's like, well, how do I come to a valuation? What do I use to measure this thing? What's a pre-money valuation, post-money valuation? What does that all mean? One of the things we mentioned in this, we went around and got coaching on how to put our deal together. The convertible gets you a free loan, right? So in the terms of the arrangement that we're taking to market right now, it's a 5-year convertible note. It's a 12% accrued coupon, and at any moment, if the investor thinks that it's worth having as an equity piece of their portfolio, they can trigger the convertible. But it gives them a free look for a period of time. So, the valuations and that kind of stuff, what I'm saying is don't put barriers up, and say, well, I'm afraid to approach capital because I don't know the language and I don't know how to do valuation and all that kind of stuff. These guys are not, wearing fangs and masks and that kind of stuff. They're not approachable. But don't let the, well, I don't know the language, and so I'm not sure quite how to get the deal prepared to even walk into the office, prevent the conversation, because you may have the cure for cancer. If you don't know how to do the valuation, they want the cure for cancer.
And if you don't understand what David just said, get some help and go talk to one.
Make it simple. I don't know how simple that would get.
But what happens, we have a lot of folks, we say convertible note, and like, I did not understand a word you were saying. So he said, okay, great, we'll help you through there and go talk to your accountant or your attorney, because this is very, very confusing. I mean, it's not easy. And we're sitting there talking about reverse convertible shares and how we're going to handle this and how we're going to discount it right now. And you're sitting there going, oh my gosh, this is a really bad idea.
Hold on. Convertible note's really simple. He gets all the first money, unless it goes really good, and then he's going to make it equity and gets even more money.
It reduces risk for both sides. But it may not necessarily have the valuation either one of us wants. If I convert my note says, I'm going to put money in as a debt instrument, I'm going to loan it to you today with a certain rate of return, 8, 10, 12%, and maybe a discount on this future round. Today, we don't know what it's worth. And so rather than sitting there and saying, let's squabble between $1 million pre-money and $5 million pre-money, we're going to do a convertible note.
Is it okay if the interest accrues?
Yes. I have a problem with that. 3 years down the road, all of a sudden it turns around and you price this thing at $5 million because now you've got a product, you got sales that we've quantified. I've got the ability to convert into it, either at a straight money or at some kind of discount or some kind of premium. So
I'm kidding around that 3 of the businesses that we're working with, all the last rounds and stuff that we've done are convertible notes, because it is the easiest way to, particularly if you're doing something that's going to require additional capital, and I think that's one, especially some of the medical stuff that you guys have done, you know it's going to take more capital, and you're going to, this certain bucket of money is going to get it to a milestone that then allows you to get additional capital. That's one case where you definitely want to do something, consider something on the convertible side.
Well, back to Chelsea's question, I would bet that, I'm going to predict what Gordon's going to say when this the question. My bet is that you don't value patents very much at all, because you don't understand it.
That's correct. I mean, there are some banks that have experience in patents, but our bank does not, and most banks do.
Most banks.
And how many deals do you do for equity?
Oh, yeah. Well, if you have outside collateral, outside income.
But it doesn't mean we can't work together, because there's a
Exactly.
point in time when you need to expand and buy equipment, that he's a great source for this. Why in the world would you want to give up equity to me or Andrew? When all you need to do is buy some equipment or finance some inventory or cover some accounts receivables or pay that back. You go through him and you find a way to do that. So we can work together to get to certain stage.
Don't, I would say don't at all get fixated on structure. This is the last thing. These are an agreement between two parties, so they can be made to do whatever needs to be done. So if there are particular issues, you can reach an agreement with that once you've sold the investor on the company. So it's kind of like you go in for a job. You don't say, I want $100,000 when you first meet them. You sell them on yourself first, and then you talk money. It's the same.
If you find the right investor, they can find more money for you, which is one of the big keys. It's like each of us has access to other folks that we can syndicate a legal deal. That's really important.
One, just throw something out here, it's not necessarily a question, but all of the things these guys have talked about that some of you may not understand, there's a book, it's John Wiley and Sons Handbook on Corporate Finance and Financing Growth, I think is the title of it. It's about an $80 book, but it covers everything from bootstrapping to bank loans to venture capital, bridge financing, you name it. And having gone through, this process, in fact, Andrew turned me down. We ended up getting the deal with somebody else. But like I said, you keep asking. You keep asking. We got to deal with somebody else. But everything in that book, spot on with all I saw in the process and all these guys are saying right now.
Andrew turned me down too, you're okay.
Andrew turned me down too.
My favorite book is a book by Keith Cunningham called Keys to the Vault. I love that book. I think it's great. It's about what investors look for when they're making loans or making debt instruments or whatever. So it's a great book on kind of how to structure a business plan, how to structure an executive summary, what the terms mean, how you evaluate things. So it's helpful.